So maybe they're more willing to negotiate. So when you ask me, or when you ask a mortgage broker, when is the right time to buy? The answer should always be, well, let's look at your finances. Let's look at your situation.
After 30 plus years in finance, 10 of which were doing debt collection, there's one thing that I can say with confidence. Most people do not understand how credit works, how credit scores work. I'm going to share some hints and tips and some shocking guidance on how to improve your credit score. So my name is Anthony Lindsay, and I've been in finance for over 30 years, so I know a thing or two. I'm going to go through the top 3 questions that I get asked about mortgages, specifically around credit. So question number 1 is, what credit score do I need to be approved for a mortgage? Another question I get asked frequently is, why was my mortgage declined? And probably the third most asked question is, why are interest rates so high? All of these questions will be answered as we go through the conversation this evening. And if you have any questions, please do put them in the chat. So as I said, I've been in finance for over 30 years. I've done everything from debt management to wealth management to lending. So I approach mortgages and debt management and credit in a very different way than many people who have just worked in one discipline. As you know, your home may be at risk of possession if you do not keep up your mortgage repayments. So very simply put, you have to think about it. Every single mortgage is going to come down to 3 things. I call it DIC. So it's going to come down to your deposit, your income, and your credit score. So your deposit, your income, and your credit score. We'll talk about strategies that we can use to improve each of those things. We'll be talking a lot about your credit, but we'll also be talking about the deposit and the income. One thing to keep in mind, and this is something that I discuss frequently, is there's a difference between your credit score and your credit profile. So your credit score is a numerical output. So it's a number, might be 700, 750, 800, 920, whatever. That's very different than your credit profile. So if you think about it this way, someone usually that has a high credit score will probably have a strong credit profile. But that's not always the case. I've had instances where I've had clients who have a high credit score, but because of missed payments or late payments, their credit profile is not as strong as someone who maybe has a lower credit score. So it's important to remember that if you have missed payments or late payments, for some lenders, they will not consider doing a mortgage for you if you've had a late or missed payment within the last 6 months, 12 months, 24 months. Every lender is going to be a little bit different, which is one of the values of going to a broker. A broker will be able to look at each individual lender's criteria and understand who will accept a mortgage based on a missed or late payment, CCJ, defaults, credit issues in the past. If you want to improve your chances of getting the best mortgage, if you do have any defaults, you want to make sure that you pay them off. So on your credit report, what you'll see is that you had a default, but it will show as satisfied. That means you've paid it. The moment that that account defaults, it's done the most damage that it's going to be able to do on your credit profile. However, if you can satisfy that and put some distance between when it was satisfied and when you apply for credit, it's going to give you more options as far as lenders. When we talk about credit cards, so we're talking about credit cards. Credit cards are one of the best ways of improving your credit profile, but only if they're used with discipline and only if you're pragmatic and you do the right things. So as a parent, a lot of people will tell their kids when they go into university, do not get a credit card. Don't get a credit card. it's not always the best advice to tell our young adults not to get a credit card, because when you don't have any credit, you don't have a credit profile, you probably don't have a good credit score, it will make it more difficult for you to qualify for products. So if you get a credit card, here's some great tips and some great ways of improving your credit score using a credit card. When you get your credit card, make sure that you don't pay off the full balance before the statement date. But I'll get in a little bit more into that shortly. So after you've had the credit card for a while, you might find that the lender or the credit card company starts to offer you credit line increases. Now, people who want to be really disciplined and don't want to get themselves in any credit troubles or any issues with their credit, they tend to not accept those credit increase offers. Now, this is a mistake, and this is one of the things that seems counterintuitive, but if you get offered a credit card limit increase, accept that credit card increase. And I'll explain why. When lenders are looking at your overall credit profile, they look at a snapshot of how much available credit you had when you first started getting credit cards for maybe a specific credit card. So let's just say you have a Capital One card and they started your credit limit at 500. They offered you credit limit increases that you did not accept, and you continue to have a $500 or pound limit. The credit card companies will look at that and say, well, why has this person's credit limit not increased in 1 year, 2 year, 3 year, 5 years, whatever period of time you've had that credit card? What they want to see is that your credit limit is increasing. That will also help you with what's called your utilization, which is another hot topic that we will be covering. But by accepting those credit card increases, it shows that you are credit worthy. It shows that people want to lend to you. Now, some lenders don't automatically offer credit limit increases, so you have to request them. So as a rule, what you can do is request a credit limit increase every 6 months. Some lenders, it will be a shorter period of time, especially the credit profile builder cards like Vanquish, Aqua, the lower level Capital One credit cards. So request a credit limit increase if you're not getting offered those increases. So credit limit increases and increasing your credit limit is one way of improving your credit score, believe it or not. It seems and sounds like something that would not help you with your credit score, but it absolutely will, as long as you are making your payments on time and not letting the balance just roll over month to month. The other thing to consider is when to pay. Now, I mentioned about not paying off the full balance before the due date. So what a lot of people will do when they're trying to build their credit profile is they'll go out and get a credit card, which is great. Go and get a credit card if you're trying to build your profile. Then they'll make purchases on the credit card and then pay it off right away. So let's just say they make the purchase on the 1st or 2nd. Then they'll see that it's showing on their balance. What they'll do is they'll pay it off. Now, the reason why this will not help you with your credit score is because there's 2 key dates that you need to remember with a credit card. They're usually different dates. They can align. In some cases, in some instances, you can ask them to align. But the 2 key dates are your statement date and your due date. So your statement date and your due date. So the statement date is the date that the statement for that credit card is produced. The due date, especially if you have a direct debit, will probably be about 14 days after the statement date. The statement date is what reports to the credit reference agencies. So again, if we use that scenario, you've used the card on the 1st, you pay it off on the 4th, and your statement date is on the 15th, by the time it comes around to the statement date, you have a 0 balance. So it looks like you're not using that card. The other danger of that is a lot of lenders will start to reduce your credit limit based on the use of the card. So if you're not using it, they will reduce that credit limit. They may even cancel the card. I know years ago when I was buying my first property, I was like, okay, I'm going to clean up my credit. I'm going to pay off all my credit cards. I'm going to make sure that I have a zero balance on all of them. And it took a while to come up with the money. So I didn't have a balance on those credit cards. I wasn't missing any payments because I didn't have a balance on those cards. And I got a notification one day that they were closing the account. I know Barclays card in the UK is notorious for reducing people's credit limits when they're not using that credit limit. So make sure that you're using the card. Make sure that you do not pay off the full balance before the statement date, and then make sure that you have a direct debit to set up to make the payments. But within that whole mantra or that methodology of leaving a balance on the credit card for when the statement date comes around, make sure that you're not utilizing too much of the available credit. So what I mean by that, let's just say you have a credit card and that credit card has £1,000 limit and you're using £100. That would be 10%. If you're using £500, that would be 50%. A very safe area to be that shows that you're a responsible borrower would be around that 10% mark. So if you go up into 60, 70, 80%, that's starting to show some red flags for lenders. So to summarize that point, when you have a credit card, use the credit card. Otherwise, you're in danger of them either reducing your limit or actually closing out that account. Do not pay off the full balance before the statement date. Make sure you lower that balance to 10% or lower. I would say between 3 and 9% of the total credit card balance. And make sure that you always make your payments by the due date. Utilization. I've talked about utilization a little bit. So utilization is essentially the amount of the available credit, the amount of your credit limit that you're utilizing, therefore the utilization. So in the example before, you have £1,000 credit limit, you're using 500, that would be 50% utilization. Now, if you're using platforms such as ClearScore or Credit Karma, it will talk to you about your utilization. But when they're talking about your utilization on some of these platforms, they're talking about the cumulative utilization. So that means, to keep the numbers easy, you might have 5 credit cards. Each of them has a credit limit of £1,000. On one credit card, you're using £900, and another credit card, you're using £800. But the other ones, you are using nothing. Your utilization will be based, your cumulative utilization will be based on those 2 cards. So your utilization will be low as a cumulative number. However, those 2 cards that you have over 50% are going to go against you. So a better strategy to improve your credit score, which could improve it by 20 to 50 points within 3 months, would be to make sure that the balance is spread across all of the cards and all of the cards' utilization is below 10%. So it doesn't make sense having 1 or 2 cards that the utilization is really high, and then you have other cards that there's a zero balance on. So your utilization is not just about the cumulative, it's about the individual card. So a strategy that you might want to use, as I said, if you have multiple cards and some of them have a zero balance and you're in a situation where that credit card company is maybe offering you a 0% balance transfer, transfer a balance onto a card, keep all of your cards below a 10% threshold. A strategy overall for getting your mortgage. Now, as I said, you're going to look at your deposit, your income, and you're also going to be looking at your credit rating or your credit profile. So a great strategy for increasing your income is looking at the things that you can do, the skills that you have, or maybe some services that you can offer people. So make sure that you're looking and being creative in the things that you can do to increase your income. I know a lot of people who have side hustles and do various different things, but they're doing cash in hand. So they may have an additional income coming in, but because it's not registering anywhere, when they go to apply for a mortgage and they're saying, oh, well, I do this particular thing, the bank has no way of verifying that additional income. So that's not going to help them. But you want to look at ways of increasing your income. The other thing is increasing your deposit. You want to increase your deposit because the more you pay down, the less the bank is lending you. And that's going to impact what's called the LTV, or loan to valuation. Loan to valuation. I do have a video on loan to valuation and explaining the implications of loan to valuation when it comes to not only your mortgage interest rate, but being able to get the very best mortgage deals. I'd also suggest that you think outside the box. Quite often we're thinking, or we go into a conversation with a broker and we have one thing in mind because we've seen something on social media. Always speak to a broker. Always speak to a broker. Always be open and honest with the broker. Always explain your circumstances and the outcomes that you're trying to achieve. There are specialist lenders out there that will work with you regardless of your situation. This week, I was really excited. I had a client who was convinced that they wouldn't be able to get a mortgage. I was able to match them with a lender that looked at their circumstances, not just through an automated underwriting process, but actually looked at them as an individual and was able to get them a mortgage. As I said, my name is Anthony Lindsay. There will be information in the description. There's a QR code right here if you want to book an appointment. There is no fee for a conversation. So we're going to continue by talking about how mortgages work in the UK, how your credit score can impact the type of mortgage that you get. A lot of people that watch my channel are first-time buyers. So they're the people that need the most support. And those are the people that I love to work with because they come in and they're open to the conversation. And the reality is 47% of people in the UK do not understand how mortgages work. And that's even people with mortgages. But first-time buyers come in knowing that they don't know what they don't know. So it's a great conversation to have. I would say always, always, always speak to a mortgage broker. Going to your bank is going to only give you one option. So I often have clients that approach me and say, oh, I can't get a mortgage. And I'll say, why do you believe you can't get a mortgage? And they say, because my bank said I can't get a mortgage. Now, if you've gone to one bank and asked that one question about your profile and they're unable to lend to you, maybe because you're on a skilled worker visa, maybe because of credit issues, because of the size of your deposit, just because that bank cannot lend to you, it doesn't mean that no bank can lend to you. So you want to approach a broker. A broker is going to give you choice. A broker is going to give you service. And a broker will talk to you about one of the most important parts of taking out your mortgage, which is protection. So you can have a mortgage and run into some issues, and they will have put something in place that can protect you in the event of death of a partner, you're off work due to sickness, you contract a critical illness. So the great thing about speaking to a broker, they'll give you that full package, as opposed to when you go to the bank, quite often you're not going to get that advised sale. There is a perfect profile for a customer. We very rarely come across these people. And these tend to be the people that will go directly to the bank because they know that they are the perfect profile. It's still not the best bet for them to go to the bank. But what does this person look like? It's someone with a UK passport. It's someone that is full-time employed, PAYE, meaning they have a fixed contract with a guaranteed income. So it's not a 0 hours contract. It means that even if they're off work sick, each month they get the same amount. So PAYE, employed for more than 12 months, meaning they're not on probation. They haven't changed jobs recently. The other part of it would be a high salary, a good credit rating, and a large deposit. So that's the ideal or perfect profile. You don't come across those people very regularly. So this conversation isn't about those people. It's about people that maybe have had some credit issues and therefore need a lender who's going to take that into account and still do a mortgage for them. The first stage of the home buying process or the mortgage process will be a conversation with a broker. When you go to the broker, as I said, you're going to need to be open and honest. I've been doing finance for over 30 years. So I can have a conversation and I can put the pieces together and figure things out. And if I can do that, the bank can definitely do that. Do not try to fool the broker or fool the bank. Algorithms and banking systems and all the information that banks have available to them is going to help them fill in the blanks. A bank would rather you go to them and say, well, I've had a missed payment, or I have this credit card, I had a divorce and it caused some issues with my finances. Because quite often when I look at someone's credit report, I'm able to pretty much figure out what's going on. Because when you look at someone's credit report, you can see how they manage their finances. So I had a client the other day who the credit report that I was looking at was all green, meaning everything was paid on time, everything was paid well. And I saw a blip where maybe a year and a half ago, there was a missed payment. And going back to what we were saying about credit score versus credit profile, the fact that they had a missed payment within the last 24 months, some lenders are going to look at that and may not approve that mortgage, as harsh as that might sound. But when I asked the person, they said, I was away and the country that I was in, I couldn't log in to make my payment. And it made sense looking at everything else. And here's a tip about your credit. You can, based on a solid credit rating like that or credit profile like that, in many cases, you can contact the lender and say, look at my overall profile. I've never missed a payment. I've been with you guys for 2 years, 3 years, 5 years. I missed one payment. Can you, as a goodwill gesture, update the credit report to show that payment was not missed? Now, they can do that as a goodwill gesture. They won't always do it, but they can do it. You don't have anything to lose by asking for that. Credit reporting agencies are only going to look at what's on there, but the lender does have the opportunity and they do have the ability to correct things on the credit file if you make a request. So first part, you're going to go and see a mortgage broker. You're going to be open and honest. The key documents that you're going to need when you go and see your mortgage broker. So the key documents you need when you go to see a mortgage broker will be 3 months bank statements. So the last 3 months, not 3 random months, 3 months bank statements, 3-month pay slips. If you're self-employed, you're probably going to need your SA 302, as well as your tax overviews. So SA 302 plus the tax overviews. If you're employed, it'll be last 3 months pay slips. If you're paid weekly or monthly, then they all have to add up to 3 months. It's also a good idea, especially if you're a carer or someone who has the ability to do overtime. It's a good idea to also bring or have your P60 available. The P60 is a document that will show how much you earned the previous year. So you may have a fixed term contract that says that you're on $33,000 a year, but due to overtime that previous year, you may have made $40,000, $45,000. And a lot of lenders will look at that and may be able to take that figure into account and say, well, actually they're on 33, but we can look at the P60, and it will open up what's called affordability. And affordability is very important. So 3 months pay slips, 3 months bank statement, P60, you'll need proof of your address. Most lenders will not accept mobile phone bills. So you need something like a utility bill, a council tax bill, something of that nature. Make sure it's within the last 3 months. You'll also need proof of deposit. So when you're putting together a deal and when you're speaking to a mortgage broker, we need to be able to verify that you actually have the money that you say you have towards the deposit. Now, in some cases, people are getting a gifted deposit. So they're getting money from bank of mom and dad or a friend or a family member. In that case, you may not have the money because you don't really want to get the money until you need the money. So you can discuss that with the mortgage broker. So 3 months bank statements, 3 months payslip, P60, SA302, and tax overview if you are self-employed, proof of address, proof of identification. Some brokers will use an online system. At my previous firm, we used to use something called CREDAS that will verify your ID. It would also verify your address. It will pick up on other things like if you're on the voters roll. And that's another thing that I do want to mention. Being on the voters roll will help improve your credit score. I'll say that again. Being on the voters roll will help improve your credit score. So if you have the opportunity and you're living somewhere and you are trying to boost your credit score between 20 and 50 points in 3 months, and you are able to go on the voters roll, go on the voters roll. So now you've met with the broker, you've had an open and honest conversation, you've told them what type of properties you're looking for, they've assessed your finances. At this point, they'll be able to generate what's called an agreement in principle. Now, in many cases, most cases, an agreement in principle won't be a hard credit search. It'll be a soft credit search. But the agreement in principle is not validating the information that's put in there. So you could go to a mortgage broker and say, I'm on 90 grand and I have £100,000 deposit. They key that into the agreement in principle. It's just going to run the numbers. The system is simply going to run the numbers. So an agreement in principle is really important because a lot of estate agents will not allow you to make an offer without an agreement in principle. However, if the numbers are not validated by the broker in advance, that agreement in principle may not convert into a full mortgage offer, which is what's important. You don't want to have an agreement in principle, spend 2 to 3 months finding the perfect property, negotiate a price, get an offer accepted, and then you go back to the mortgage broker and you say, I want to purchase this house. Then they come back to you and say, oh, the lender won't lend because of credit issues, etc. That's why it's very important that you provide those documents in advance. And hopefully you're working with a broker that's going to do all of their due diligence first. I know the firm that I work for, we do all of the due diligence, all of the compliance up front. That way we know if we're doing an agreement in principle for someone and they go through the hard work of finding a property, getting an offer accepted, when we convert that agreement in principle into a full mortgage offer, it's more likely to go through because we've already looked at the credit profile, we've looked at the income, unless something that neither the broker or the client knows about that's happening in the background. In most cases, especially with our firm, it will convert into a full mortgage offer. During that full mortgage offer process, it will trigger a valuation. So that's when the lender evaluates or values the property. So it's not a survey, it's a valuation. And there's a difference. So the valuation is for the bank to confirm that the property that is the security property, the property that you're buying, is worth what you say it is and what the seller is selling it for. There's 3 things that can happen when you do the valuation. The valuation can come in at the figure that was discussed, so the seller's selling price. That's great. So the bank goes out, you say that you're purchasing the property for $475. The bank goes out, so yep, we think it's worth $475. That's fine. The bank could come back and say, well, we believe that the property is worth more. But what you don't want to happen is for the bank or the lender to do a valuation and come back and say that that property is worth less. Because if that's the case, you're either going to have to come up with a higher deposit or you're going to have to adjust the mortgage amount. And depending on your affordability, that may cause the deal to fall through. Once you have that mortgage offer, that's when the solicitors kick in. I would highly recommend that when you're speaking to your broker and you start the process, you start to explore solicitors, because once you get to the full mortgage application, that's when they're going to start asking you who your solicitor is, contact details, address, etc. And that's not the time to start looking for a solicitor. So then you go through the process of the legal work, conveyancing, then you go to exchange, completion, and the thing that you really wanted. I mean, let's be honest, nobody wants a mortgage, people want a home. So you've gone to a mortgage broker because you need a mortgage to get the home, and this will take you through that process, the completion, and then the move in. I just want to give some tips on getting the best mortgage. So this will go into the deposit side of things. Move your deposit into a high savings account to maximize the interest. Quite often, people send me their bank statements and I ask them for proof of savings, and they say, hey, it's in my current account. If you're with a high street bank, more likely than not, the interest that you're getting on that money there is little or nothing. So what I would recommend, go to Money Savings Expert, research some accounts, find an account that has a high interest rate. You can break it up into 3 different categories. You can put some of the money in a savings account where maybe you need a 30 or 60-day notice, because when you're going to use that money, when you're going to utilize the money in your bank account to transfer over to make the purchase, it's quite far into the process. So you will have notice. It's not going to happen overnight. So you could potentially put a lump sum in a 30 or 60-day notice account, then put another bit in maybe a 30-day notice account and another in a 7-day notice. What you'll find is the longer the notice period, in most cases, the higher the interest rate that you will receive. Make sure you do your due diligence. I'm not an accountant. I'm not a solicitor. I'm not giving legal advice. I'm just giving you some guidance on how to find the best interest rates. Do understand that if you go above a certain amount of interest earned in a tax year, it may have tax implications. So please speak to an accountant. So put that money in a high interest savings account. Clean up your credit. So clear debts, but do not close credit cards. I'll say that again. Clear your debts, but do not close credit cards. This session is about how to improve your credit score and credit profile. So keep in mind, as we said earlier, your credit utilization is based on your available credit limits. So if you have a credit card, especially a credit card that you've had for a while, and then you close it, it's not only going to shorten the average time that you've had credit, it's going to decrease your available credit and potentially raise your utilization. So don't close the credit card. I got asked that this week. I'm preparing for a mortgage and I have some credit cards. I paid them off. Should I close them? The answer is no. Don't close the credit card. The other thing is, make sure that you look at your bank statement. Go through your bank statement thoroughly. Look at things that maybe you're duplicating. So right now, pretty much any subscription service that you get, whether it be a phone subscription, they're offering you either Netflix or Amazon Prime or Disney Plus. So if you're paying for Disney Plus or Netflix and you have it free with a bank account or maybe a mobile phone, you can get rid of the one that you're paying for. Okay, so you're not going to get rid of the mobile phone, but you would probably get rid of the standalone subscription for Netflix. So make sure you go through your bank statement thoroughly. Make sure you understand every single thing that's coming out, the purpose of it. Sometimes with insurances, I had a client this week who was paying insurance on their refrigerator and on some other appliances they had. I explained to the client that a lot of appliances, most appliances, have a manufacturer warranty. So I advised her, don't just go out and cancel this subscription, but look at what you're getting for it. Is it duplicated in the manufacturer warranty? It's usually an upsell that these stores do to say, oh, well, you're going to need this insurance. It can come in handy if you need it, but if you don't need it and you want to increase your deposit by having more money, if you want to decrease your outgoings by having less going out, you can look at those things and look to cancel those things. The other thing that I would say is make sure that you don't just change jobs. I mean, obviously, if you're going to get a pay increase, then you'd want to do that. But when you change jobs, it is something that will eliminate some lenders, because some lenders won't lend while you're in probation. Other lenders will lend just with an offer letter if you're switching jobs and you're staying in the same field. So let's just say you're an accountant and you're going from one firm to another. They're like, well, this person's getting an increase. It's okay. So professions like that, lenders are a lot more flexible with. So maintain a steady job, a steady income, avoid taking out new debts or making large purchases. So keep your spending under control during the mortgage application process and before. I've seen clients who had an agreement in principle. They then went out and took out a huge loan between the decision in principle and the offer. And then when we were trying to get the full mortgage application, it declined because now they had to take into account that new payment that had happened between the agreement in principle and the full mortgage offer. So what are the next steps? The first thing that you want to do is speak to a broker. I see it and hear it all the time, and it is a little bit frustrating. People go out and search for a property, go through all the hard work of finding a property, negotiating a property. Then they call me and they're like, Anthony, I just got an offer accepted for $450,000. I need an agreement in principle. I need a mortgage. And guess what happens? We process the figures and they can't afford the house. And it's a frustrating thing because they could have avoided that by speaking to a broker first. Most brokers are going to have that conversation with you and give you guidance on how much you can borrow. Here's a quick tip. This is not something that I want you to go out and tell all your friends. However, this is a good way of assessing how much you may be able to get a mortgage for. You take your income, and if it's two people, the combined income, multiply that by 4.5, and then that's going to come up with the base mortgage amount, and then add your deposit. But make sure that the deposit, if you want to get most lenders, the deposit is around 10%. There are lenders that will lend with a 5% deposit, but I'm just talking about how to get a pretty accurate figure of how much you'd be able to borrow based on meeting all the criteria. If you're in a situation where maybe you're on a skilled worker visa, you have a low deposit, you have low income, anything like that, then this formula may not be best. But just as a rule of thumb, get your income, multiply it by 4.5, add the deposit amount, and that's how much you can afford. One of the things that I love about mortgages and working in finance is numbers are numbers. Numbers are not emotional. Numbers aren't there to trip you up. They are what they are. So it's a little bit frustrating for people when they speak to me and I say, well, based on your income, your deposit, your outgoings, this is how much you can get. And they need an extra 100,000 or extra 150,000. There are specialist lenders that can sometimes increase the multiple of your income. So there are lenders that will go up to 6 times and some that go a little bit above that. But if you're dealing with a specialist lender, you're usually going to be paying a higher interest rate, which means a higher monthly payment. And that's okay. If that's what you need to do to get into a home that you can afford and that you love, then that's okay. But if you can get an agreement in principle, then search within the price range that you know you can get a mortgage for with the best lender based on your circumstances. So you get your agreement in principle, you start house hunting, and then you come back to me and we can get you that purchase started. My name is Anthony Lindsay, and I'm here to answer your questions. So if you'd like to book an appointment with me, you can use the QR code. You can read the information in the description, and you can get in contact with me. Consultations are free. I love working with complex cases, so people who maybe have had some credit bumps, people who are first-time buyers, people who are on skilled worker visas, people who are self-employed or contractors, all of that weird and wonderful stuff. The straightforward, high income, UK passport, high deposit, those people are great people too, but I love being able to help people who didn't think that they would be able to get a mortgage. I'm launching something that hopefully many of the people that watch this will find very valuable. I'm launching something called the Mortgage Ready Challenge. The Mortgage Ready Challenge is for anybody who's planning on purchasing a home within the next 6 months. So the idea is, as of the airing of this video, you'll be mortgage ready by summer, that you can be in your new home by next Christmas. So that's the Mortgage Ready Challenge. The benefits of the Mortgage Ready Challenge are: A, we will get you in a position to get you the very best mortgage based on your circumstances within the next 3 to 4 months. So we'll help you clean up your credit, we'll help you increase your income, and we'll give you some tips on how to increase your deposit. The Mortgage Ready Challenge will also enable you to have lower broker fees. So if you come back to me within the next 6 months and I do a mortgage for you that goes to a full mortgage offer, you'll get 50% off my broker fees. You'll also be a part of our private group that we support each other. It's a business networking group where we'll help you if you're looking to do a side hustle, if you're looking to generate some additional funds, if you need support in building your website or getting your business out there or finding clients, you'll be able to do that. You'll get additional resources. We'll have some training on some property strategies, because let's face it, people often feel that they have to get a mortgage because they have to own, because they feel that everyone should own a home. Having a mortgage and owning a home is not right for everybody. There are some downsides to owning. So keep in mind, when you own your home, unlike renting, when you're renting and you have a leak or something goes wrong, you call the landlord. When you own, you're responsible for that. So there's additional expenses that come along with owning your home. So we have courses that we go through other property strategies. You'll have access to those courses. You'll have access to credit tips. You'll have access to just a ton of information. So the goal of the Mortgage Ready Challenge is not only to get you mortgage ready by summer, that you can be in your new home by Christmas, but the other point of the Mortgage Ready Challenge is to increase your income, decrease your outgoings, and build up a bigger deposit that you can get the very best mortgage. My name is Anthony Lindsay, and I hope to speak to each of you at some point. I appreciate all of your time, and I appreciate you tuning in. Make sure you look at the description in the information in the description. All my links are there. I'm on LinkedIn, I'm on social media, and I'm here to help you. So if you have a first-time buyer question, if you have a credit question, if you just want to speak to someone that's going to give you honest advice on how to buy your home, remortgage, do a buy to let, make sure that you reach out.